Welcome back to XRP Hub, where we deliver structured macro analysis on digital asset markets before the broader narrative catches up. Today's discussion addresses a structural shift unfolding beneath the surface of the XRP ecosystem. A threshold has been crossed that signals transition from passive holding toward productive deployment, and it materially changes how sophisticated capital should evaluate XRP exposure. The market is no longer in a phase where simply waiting for price appreciation is sufficient. The question is not whether XRP can appreciate in value. The question is whether XRP can begin functioning as yield-generating infrastructure within a programmable financial environment. That distinction defines the next cycle. A network aligned specifically with XRP utility has now surpassed 100 million in wrapped XRP minted, establishing the first meaningful scale point for programmable deployment without custodial dependency. This is not a speculative headline. It is an infrastructure milestone. Most participants still frame XRP as a settlement token defined by speed, cost efficiency, and institutional alignment. Those attributes remain foundational. However, speed and low fees alone do not generate returns if capital remains idle. Programmability, decentralized finance access, and non-custodial yield mechanisms are the structural requirements of this phase. The network that has crossed this 100 million threshold is positioning itself as the execution layer that enables XRP to participate in these mechanics while preserving decentralization principles. The market is transitioning from speculation toward utilization. The assets that outperform in this cycle will be those integrated into real protocols, generating measurable economic activity. Passive exposure is being replaced by productive participation. The development in focus is the milestone achieved by Flare Network, which has minted over 100 million FXRP. FXRP represents wrapped XRP operating within Flare's programmable environment, engineered with over-collateralized and non-custodial architecture rather than centralized custody models. This distinction is critical. Traditional wrapped assets often rely on trust assumptions around custodians or multi-signature operators. Flare's F-asset system is structured with on-chain collateralization mechanisms designed to enforce solvency algorithmically. The system does not depend on trust in an intermediary. It depends on code-enforced collateral ratios. Crossing 100 million in minted FXRP is not about absolute size relative to larger DeFi ecosystems. It is about proof of demand within the XRP holder base. For years, a prevailing assumption suggested XRP participants were indifferent to decentralized finance applications. The data now challenges that view. Capital has migrated because holders are seeking lending markets, liquidity pools, borrowing facilities, and yield opportunities without relinquishing control to centralized exchanges. That migration signals behavioral evolution within the ecosystem. Flare's strategic positioning is differentiated. Competing Layer 1 networks optimize primarily for their native assets. Flare's thesis is explicitly centered on extending XRP utility into programmable finance. Development has spanned multiple years, including extended token distribution programs and infrastructure build-out before attempting scale acceleration. When FXRP is minted, XRP liquidity is injected into the Flare economy. Increased activity generates transaction fees, strengthens decentralized exchange liquidity, and expands economic throughput across the network. This creates a reinforcing cycle where higher participation deepens liquidity, which in turn enhances reliability and efficiency. Once converted to FXRP, holders can deploy capital into staking, decentralized exchange liquidity provisioning, lending protocols, and borrowing markets. Yield emerges from network participation, fee distribution, and incentive structures aligned with long-term engagement rather than short-term emissions. Flare's architecture incorporates decentralized oracle systems that merge time series price feeds with cross-chain state verification. Participants staking FLR tokens contribute to securing data infrastructure, earning a share of protocol-generated fees. This model ties returns to operational network function rather than unsustainable yield farming constructs. An additional development involves the rollout of smart account functionality designed to integrate XRP ledger addresses directly with Flare's execution environment. This enables transaction instructions initiated on the XRP ledger to trigger programmable outcomes within Flare's ecosystem. The structure reduces complexity and minimizes traditional bridge risk. The practical implication is significant. XRP holders can access decentralized finance tools while maintaining alignment with the XRP ledger identity structure. Adoption friction declines and integration becomes seamless rather than fragmented across multiple wallet systems. Network growth metrics reinforce the infrastructure thesis. Total value locked has expanded materially year over year, decentralized exchange liquidity has increased substantially, and daily transaction counts reflect accelerating usage. Stablecoin integrations have further amplified capital inflows, underscoring operational rather than purely speculative activity. Stablecoins function as liquidity anchors within DeFi ecosystems. Their growth on Flare signals that capital is being deployed for trading, lending, and liquidity provisioning rather than idle speculation. Expansion in stablecoin market capitalization is therefore a leading indicator of ecosystem maturity. Flare has secured institutional capital backing and formed strategic partnerships to expand adoption corridors, including initiatives bridging regulated markets in Asia. These developments reflect enterprise-level engagement rather than isolated retail experimentation. Leadership alignment across the broader XRP ecosystem reinforces strategic coherence. Executives from Ripple, including Brad Garlinghouse and David Schwartz, have publicly acknowledged Flare's role in extending XRP's functionality. This alignment suggests ecosystem coordination rather than competitive fragmentation. The structural relationship can be framed clearly. The XRP ledger functions as a high-speed settlement rail. Flare operates as a programmable execution environment layered alongside it. Together they form a complementary system where settlement and smart contract logic coexist without compromising core performance characteristics. Security architecture remains central to adoption. Flare's F-asset model utilizes over-collateralization mechanisms designed to protect against insolvency events. In stress scenarios, collateral liquidation processes are algorithmically triggered to maintain backing integrity. This differentiates the system from centralized bridges historically vulnerable to hacks or mismanagement. From a capital allocation perspective, the implications are straightforward. Consider a holder maintaining a long-term XRP position awaiting macro-driven price expansion. Idle capital generates no interim return. Converting a portion into FXRP and deploying into yield-generating protocols introduces income while retaining one-to-one exposure to XRP price dynamics. Yield compounds. In appreciating markets, yield denominated in XRP magnifies dollar-based returns. This transforms the risk-return profile from purely directional exposure to hybrid exposure combining appreciation and income. Liquidity provisioning offers an additional vector. By supplying FXRP into decentralized exchange pools, participants earn trading fees and potential incentive rewards. Revenue streams diversify without relinquishing custody to centralized intermediaries. Risk considerations remain present. No protocol is immune to failure. However, multi-year development cycles, transparent architecture, institutional engagement, and measurable on-chain growth metrics reduce the probability of structural fragility relative to early cycle experiments. The broader conclusion extends beyond a single network. XRP requires programmability to remain competitive in a landscape where capital increasingly demands yield and composability. The milestone of 100 million FXRP minted demonstrates that this demand exists within the XRP holder base. Even if ecosystem leadership evolves over time, the direction is established. Productive holding is replacing passive holding. Yield integration is becoming a prerequisite for capital retention in digital asset portfolios. Participants evaluating this transition should begin with education. Understanding non-custodial wrapping mechanisms, oracle design, collateralization ratios, and smart account integration is foundational. Deployment should be incremental, scaling exposure as familiarity increases. The infrastructure now exists. The threshold has been crossed. XRP is no longer confined to static settlement functionality. The strategic question is whether holders adapt to the infrastructure being built or remain positioned solely for price speculation. The market is signaling that utilization will define the winners of the next cycle. This is XRP Hub, delivering macro-structured analysis as digital asset infrastructure evolves.